Hello. The premise of the Outperformance Matters podcast is that active fund managers must focus on outperforming the returns of passively managed index trackers to justify their higher fee. But remarkably few funds achieve that. Only about 15% of global funds in 2024, a figure that's relatively consistent. Why? Well, that's what we're trying to discover. In each episode, we uncover approaches of investment styles that can help deliver outperformance. I'm Richard Edgar, and this is Outperformance Matters, the podcast from Blue Whale Capital. Well, we're guided, as always, by Stephen Yu, the Chief Investment Officer of Blue Whale Capital. Welcome to you.
Hello, Richard.
Hello there. Now, this time we're discussing something that sounds quite simple. How many stocks should you have in a fund?
So there are no correct answer to that. But as we talked about in our previous episode about contrarian investing, is you need to be very different to your benchmark or the index. So on a very high level, you should have much fewer stocks in order to outperform the benchmark.
In order to outperform. Okay, so diversification, which is like one of the oldest rules in investing, is not the way to go if you want outperformance. That's your point.
So there's a saying, I think it's by Warren Buffett, that diversification might preserve wealth, but concentration builds wealth.
Concentration builds wealth. Okay, well, that's something that we will come to in a little while. That's the main theme for this episode. But what we're going to do now is turn, first of all, to the macro and markets section, your views on current themes. And you're going to talk about one specific market here in London, because the London Stock Exchange itself is in the news as some companies choose to delist, they come off the exchange, or they move to different markets, often in the US, or some large private companies that we might have expected would come to the market, would IPO, have decided not to do that and to stay private. So what's going on?
So I think on a very high level, as we know that London Stock Exchange probably has lost its competitiveness relative to other stock exchange globally. And we couldn't attract new companies coming to list. And at the same time, we're losing very large companies that are going to list overseas at the same time. So from my perspective, it's very sad that we couldn't make it work, and we need to do more on the back of this.
And just to explain, you're saying that it's not competitive anymore compared with other markets. What do you mean? Why is it not competitive?
So Bloomberg recently reported that the London Stock Exchange, in terms of the activities, has lost its top spot and is now even behind Mexico, outside the top 20.
Outside of the top 20 countries for IPOs, for initial public offering.
Correct. And then secondly, I think there's a lot of listing rules that we have in place, which I would suggest that is probably not very current or not very competitive. For example, the dual share classes that the US would have got for most for startup companies. And even like in Hong Kong, they are at the moment exploring certain regime that we don't have here.
So it's much easier to list in other markets. I mean, to be fair to the LSE, in recent days there's been a little flurry of announcements of companies intending to list on London. There was one in the last week or so which did manage to get away successfully. But I saw another data point that London has raised so far $545 million this year, and that compares with $33 billion in the New York market. So it is a long way behind, isn't it?
Correct, yeah.
And what do you want to happen? What do you think would change this? What would make London more competitive?
So what I have been probably pushing recently is I believe that London Stock Exchange as a market should be an independently run business. Currently, it's part of LSEG Group, which is only made up about 3% of the business. And I think if we have an independent board of directors with a lot of British institutions or pension funds, which they probably would want to have a stake in the business. At the same time, the government could take a cornerstone stake in the company. And I think there's more things that we can do with the direction of travel to make London stock market great again.
So many people might not know that the London Stock Exchange itself only makes up a tiny fraction of the London Stock Exchange group. What is the rest of the group? Why is the company focused, do you think, on the rest of the group instead of the exchange?
So I would have to disclose that we are a shareholder in LSEG Group in a way that is more of a financial data company. And that's when they probably acquire Refinitiv about
From Reuters.
Reuters about probably 6-7 years ago. And now London Stock Exchange as a business within LSEG has been heavily diluted. And I think the management team probably have not focused enough to make the business to be extremely successful in the context of UK or London.
So spinning it off, your view is spinning it out of the group and to become an independent company would allow new capital to come in and a new focus on improving the market for companies to list in London.
That's right. So I think if we could have an independent board to basically dictate the agenda on what London want to become, and at the same time, I'm afraid that we are probably losing the status as London losing the status as a global financial market.
Well, if it's falling out of the top 20 for IPOs, that would seem to be a risk in terms of the impact on the rest of the market. I was going to ask you, why does it matter whether companies list here or list elsewhere? The trading can happen anywhere, can't it?
Yeah, I think on a very high level, everyone would know this, that even though that we don't want to accept that, is everyone have their home bias. Right. If you are American in America, you probably ended up investing into American stocks or stocks that are listed in the US. If you're UK or Italian or even in Asia, you ended up investing more into your local markets or stocks that are being listed there. So what we have seen so far is there's lack of investors' interest in investing in the UK especially. I mean, we would have seen some data about so much money has been parked in a cash ISA, and the government is trying very hard to get people to invest into the market. But if we haven't got good companies or interesting companies to invest into domestically or listed in the UK, and you are asking people to invest overseas, I think that's much a difficult ask, just because most people would rather just to invest domestically. So hence, I think the lack of good companies in the London Stock Exchange is going to prevent people from building wealth, or at the same time to have an interest to invest for the long term.
And attracting capital to be invested into British companies. Okay, well, you've written about this a few times, most recently an opinion piece in the Financial News. You've spoken about it in the past. You make a clear case. Do you think it's actually going to happen? Do you think that LSEG will listen to you?
So I think there's a few things going on here. Obviously, recently the chief executive or LSES made a comment that London Stock Exchange is not for sale. I think that's not what we are pushing for. And the company's got in touch, and I look forward to share some ideas with them. I think what we're asking here is that if London Stock Exchange could still be part of, could still utilize certain services with LSEG. So let's say maybe they still own a smaller stake. But then if London Stock Exchange could be an independently run company and listed in the London Stock Exchange itself, I think it could be very interesting. And I do believe that as someone who works and lives in London, that London Stock Exchange is a jewel in the city of London's crown. So I want to see a return of form of a national champion.
A jewel in the crown. All right. Well, thank you very much, Stephen. Keep us updated on the changes. Right, Stephen, back to our main topic related to Outperformance Matters, which is the right number of stocks to have in a fund. We'll get onto the idea of concentration of high conviction funds in a moment. But most people are brought up with quite the opposite notion, that the sensible thing to do is to diversify your investments. And most global funds here in the UK have got, perhaps 60 stocks in them, some of them well over 100. And of course, if you think about index funds, they've got hundreds, sometimes over 1,000 in them. So first of all, what's the upside of diversification like that? Whether it's an active fund with a large number of stocks in it or an index with a very large number, what's the advantage to the investor?
So it depends on what you're trying to achieve. As I mentioned earlier, that if you want to preserve wealth, which means that you just not want to take too much risk in anything that you invest into, diversification probably would do the job for you, right? If you think about the MSCI World Index, the iShares, if you invest into that ETF, you would have about 1,300 stocks.
1,300,
so most stocks who probably didn't do well would not have a material impact in your overall investment. But of course, the other opposite spectrum of this is probably more difficult for you to make more money than some other people who might have fewer stocks.
And to repeat a point that you've made in other episodes of this podcast, you think that for most people, a passive fund, an index tracker, is the right way to invest.
I think the reality is passive tracker or ETF has outperformed most active managers. So if we talk about Outperformance Matters, that is what outperformance means, right? Like if you can invest into a passive ETF that have outperformed majority of active funds, I think it's better for most investors to go in that direction.
85% in global funds. I mean, that is a remarkable statistic, isn't it? Now, instead, though, some fund managers decide to take a different tack and in order to outperform, have a smaller number of stocks in their fund. And in fact, that is a question that a listener, Dave, has written in with. He asks, when is high conviction too high conviction? Or in context, he says, to what extent are you balancing risk and rewards with a small number of stocks? If there's a scale where you've got 100% of your money invested in one stock, and at the other end, your cash invested in 1,300 stocks, say the MSCI world, where is the sweet spot in that? So we're getting closer to what you think is the right number for of stocks to have in a fund.
Yeah, thanks, Dave, for the question. So from my perspective, obviously, I wouldn't recommend 100% in one stock. I think that would be a bit too excessive. And equally, 1,300 stocks, if you invest in the ETF, is definitely too much. So from my previous experience that I have run a strategy that invests into about 60 stocks, very diversified portfolio. But that was a period of time that we were tasked by a fund of funds who basically engaged with 10 different fund managers to ask them to come up with the 10 best ideas from our diversified portfolio.
From your 60?
From our 60. So basically we picked the 10 best ideas from our 60 and then we basically share this with that fund of funds, and then they would be able to put a portfolio together with the other 9 managers who also come up with that 10 best ideas. And for the couple of years that I have run the strategy, I learned that the results or the outperformance that we have managed to deliver on the back of the 10 stocks is almost double of the 60 stocks portfolio. So what it was telling me at the time was concentration works. And typically, I think even for active managers, you probably cannot have high conviction in too many stocks. So that will be certain stocks that you know a lot better, which you have larger weighting. There's also a tail of stocks that you might not know as well, but that you probably want them to be in the fund just because you thought it's going to provide a diversification, but actually is distracting returns when you invest into things that you don't know as well, and you should actually concentrate into stocks that you know very well of.
So your experience there of your 10 best ideas, the 10 best stocks in your fund outperforming the rest, doubled the performance. Interestingly, there's academic work to support your approach, because while I was researching for this episode, I came across a paper from Harvard called Best Ideas, and they found that for most active managers, so not just where you were working, but this applies across the market, only their highest conviction stocks outperform the market. The rest of their holdings put in there to reduce volatility or whatever it might be, don't contribute to alpha, don't contribute to outperformance. In fact, they might even detract from it. So does that mean that the ideal fund has got 10 stocks in it or more?
My ideal number, if I can just run any strategies, it would be between 10 to 15. And
but you don't have 10 to 15 in your stock?
I have between 25 to 30. And the reason being is if you're running a strategy that's available to most investors in the UK or Europe, there's this regulation called UCITS 5-10-40, which means that no single position is allowed to be above 10%, and any position above 5% cannot be more than 40% in aggregate. So mathematically...
Okay, so let's go through that one more time, Stephen, because it's a complicated rule, but this UCITS regulation. So you can't have more than 10% of any one stock in your fund. And you can't have anything over 5%. All of the stocks that each of them is over 5% can't add up to more than 40% overall. So that's what contains the concentration in the fund at the moment. Is that right?
That's right.
Okay. So moving on then, that implies that if you've got a successful company in your fund and it keeps on growing, then as it hits 10%, as I understand it, you then have to sell off this successful company. You're a forced seller in a sense.
That's right. So just imagine if you had a 10% holding in NVIDIA when it surpassed $1 trillion in market cap back in June 2023. And then NVIDIA doubled to $2 trillion within 6 months' time. You would end up being a forced seller on a daily basis to rebalance the fund to bring it back below 10%. And of course, what we know about NVIDIA throughout that journey was that it then gone up from $2 trillion to $3 trillion, and today is $4.5 trillion. So as an active manager running a UCITS mandate, you would end up becoming a forced seller, or you're forced to take profits, which is very, I would say, unconventional, that you're selling a winner continuously.
You look uncomfortable as you talk about this. Selling a winner, that doesn't sound like it comes naturally to you.
Yeah, the reason being, if you follow our episode 1, I talk about how smart the machine is, which is passive trackers. And the strength of a passive tracker is they can continue to buy winners and sell losers on a daily basis. So you think about NVIDIA's weighting within the MSCI World Index has gone up from 1.5% back in June 2023 to about 6% in today's market cap number, which is about $4 trillion for NVIDIA.
So it's quadrupled in that time.
Correct. So hence the weighting within the index has actually gone up 4 times. While if you're running a high conviction portfolio with NVIDIA at 10% 2-3 years ago, then you had ended up being a forced seller to keep the weighting at 10%.
Taking a haircut in your stake, selling it off each time as the company grows. I guess that forces you then to find other winning companies. So what's interesting then is that the regulations take a view on protecting wealth within an active fund, but allowing growth in a passive fund. It does seem a little bit odd.
Yeah, so if you think about what the regulation is trying to do is to reduce concentration, which things could actually go wrong. I mean, even though that maybe you have done enough work on it. And Warren Buffett said diversification is a protection against ignorance.
And there are, to be fair, plenty of examples of funds that have blown up when they've taken the wrong decision and when they have been concentrated and people have lost a lot of money.
That's right.
But the other part of Warren Buffett's quote,
if you know what you're doing, then you should be able to navigate the environment much better.
And you need to concentrate in order to do that growth. Okay, fine. Well, what is it then that you're missing? If you've got 25 stocks in a fund, what about the 1,275 that remain in the MSCI world as a universe that could be invested in? What are you missing out on if you've only got these 25?
I don't think you miss out anything apart from underperformers, just because if you think about going back to our first episode again, that there are about 1,300 stocks in the MSCI World Index. And at any one point in time, there's going to be more underperformers than outperformers. So if you ended up running a strategy that are more highly concentrated and you can pick more outperformers than underperformers, then you would have done very well and you would have beaten the benchmark.
Okay. All right. So we've been talking about this very much from a professional fund manager's point of view. What about investors, though? What should they do in order to start thinking about this outperformance? What's the tactic for them if they're thinking about investing in funds? You've said before about passive funds being good for most people. What's the next step then?
So passive funds does provide a lot of diversification, which we are pro. But it's very extreme diversification. So anyone would have the MSCI World Index ETF would already have 1,300 stocks in that portfolio, right? And then they can think about, okay, what other things they might want to invest into. And there's this saying about don't put all your eggs into one basket. And I think there's a lot of truth in it. But what investors need to remember is a basket, to me, represents an investment approach. So if you invest into the index, the passive tracker is an investment approach. That investment approach or the basket would have 1,300 stocks. If you invest into a highly concentrated portfolio or high conviction mandate, you might have 25 stocks in one basket. And you also have some cross-sec tracker or overly diversified portfolio with 100 stocks, then you will have 100 stocks in one basket. So what I'm trying to say here is any baskets are different because it reflects the skill sets of the fund manager, the research, the team approach, etc. But it's still one basket. So you probably want to have a few baskets, and it doesn't really matter that much whether the number of stocks that in that basket, whether 1,300, 25, or 100, as long as you can outperform, then it's good enough that you should have that basket.
So small investors should be thinking about each of the funds that they've invested in as a separate basket, and that's where not having all your eggs in the same basket makes sense, that you've got a number of different baskets.
Correct.
Okay. It doesn't remove the fact that an investor will still see volatility in one of those or all of those baskets.
So what is important to differentiate is volatility in the stock market, which is a function of when you invest into publicly traded securities rather than private companies. There's probably no volatility to speak of. But at the same time, you need to then assess the risk of a permanent loss of capital. So what I'm saying here is, let's say if you're 25 eggs in one basket versus 100 eggs in another basket, the most important thing is how many good eggs are in a basket. If you have 25 and most of the eggs are good eggs, then I think your risk of losing your capital is a lot lower versus when you have 100 eggs in one basket and most eggs are not good eggs.
More chance of the eggs going off
Correct.
If there are a lot of them in a particular basket. Okay, I'm seeing eggs. It almost begins to feel a little bit like Easter now. But let's move on slightly. Talking about if a fund manager has, let's say, 25 stocks and the universe is 1,300, that must feel quite limiting. I mean, drawing on your own experience, is there not some temptation always to add a few more? I've got another question from a listener that's sort of related. This is from Owen, who puts it another way, actually. He says, how do you deal with underperforming stocks, and what's the process for either maintaining your conviction, reducing the holding, or cutting it completely? So how do you keep the discipline as a fund manager of only having 25 and not just, adding a few in or keeping something because you kind of like it?
So I will have to go back to the eggs in basket analogy. So let's imagine if 25 eggs in the basket.
Yes.
I mean, you're spending the majority of your time to watch your eggs very closely, because that's the most important thing.
Of your stocks.
The most important thing is what you have in your portfolio rather than things that are not in your portfolio. But at the same time, as good investor, you need to keep your eyes open to see what's out there, the other 1,275 eggs that's not in your basket. And if you ended up sporting some better eggs than what you have got in your basket, you want to replace them. So having a high conviction approach is actually a very good discipline to keep optimizing your basket for the best outperformance potential. And it would be a lot better than you just keep adding eggs into your basket without replacing some of the less competitive ones.
So is it one in, one out, something like that?
It should be one in, one out if you decide to run a high conviction mandate. So let's say you set a limit, whatever the number is, that you need to embrace that discipline.
Okay, I'm managing not to be scrambled yet, so and I won't do any more egg puns. I'm sorry. If high conviction, I mean, you've set out a very convincing argument for why it's actually only a very few number of stocks that are ever going to deliver the outperformance, the ones where you've got the highest conviction. I guess that's where it comes from. But if that is the case, then why don't more fund managers take this approach? Why do most fund managers fill their funds with 60, as we were discussing earlier, maybe over 100 stocks?
So in reality, it's harder than it seems, just because when you have only 25 eggs or 25 stocks in your basket, that you need to do a lot more work. You need to be certain that you have enough deep dive research. You need to stay on top of the development very closely. Just imagine if you might have 100 stocks in a portfolio, and every stock only made up with 1% in weighting. If a couple of these names doesn't work out, it's probably not going to materially impact the performance of the fund. But if you only have 25 stocks, let's say on average maybe 4% weighting, a couple of them not working out would be quite detrimental. My take on active managers is most of my peers, I think historically, would probably worry more about their career risk. So by taking less risk or to be more close to an index or hugging the benchmark as we call it, that you reduce your risk of being found out in a way that you could
found out.
Yeah, when you underperform every year, that number is going to be very small. But over extended period of time, you have underperformed the market significantly, then people would then decide to take money out. But on the other hand, if you're running a high conviction mandate, if you are not very good at your job, you'll probably get found out quite quickly.
You've got nowhere to hide.
Yeah, you have got nowhere to hide. So hence, I think for people who end up running high conviction mandate, you actually need to be very confident and you need to be very experienced, that you know what you're doing. And then at the same time, you need to put in the investment resource behind the scene to back up your conviction.
Interesting. You've got to be good. Okay. Well, Stephen, I think we're coming to the end of this section. Just to sum it up, we've talked a lot about eggs, good and bad, in and out of baskets. And the idea that you've set out is that it's thinking about those different baskets. That's the way to approach investing as an individual investor rather than a professional.
Correct.
Well, now it's time to dive into the Outperformance Matters myth-busting toolkit. Stephen, I know this is your favorite part of our discussions in each episode. So what is the myth that you are going to bust this time?
The myth is equity income is a good investment.
So that's the myth. Why do you think it's wrong? Why is equity income investing not a good thing?
I can understand why people might want to have a regular income from their investment, but it's a lot better off if people were just to buy an annuity that would pay out a fixed income over an extended period of time. It's guaranteed almost. Doesn't come with risk.
Equity risk.
But if you invest into a company, it does come with equity risk or volatility in the market. Or at the same time, if the manager have not done a good job, then it comes with permanent loss of capital. So I do not think that's a good way to receive an income. But at the same time, that when you think about companies who were forced to pay out a regular dividend, that actually ties the hand of the management team to be able to invest more money into the business, to make the business more competitive, to expand the business. At the same time, the flexibility of them doing things that they might want to do has been reduced significantly.
So it hits the performance of a company by creating the expectation of a dividend. That means that they don't have the money to reinvest in the company, making it better.
Correct. So my take on most British businesses that are listed in the stock market, most of the companies are paying a dividend, just because I think equity income investing is quite a big part of the UK stock market, not so much in Asia, not so much in America.
Where people rely on the capital gain, the capital growth, the growth in the share price.
Yes, outside of the UK. But of course, I think that has reduced the competitiveness of British companies over time relative to other counterparts, just because you have less money to reinvest into a business to make it stronger. So my take on this is, if you follow Berkshire Hathaway, run by Warren Buffett, he's never pays out dividend. But at the same time, it doesn't mean that a company doesn't return cash to shareholders. They do return cash to shareholders through share buybacks or special dividends, mostly in the US. But that gives the management team a lot of flexibility. So I think from an investor perspective, what we should be looking at is total shareholder return. So it's a combination of dividend that you might receive. At the same time, is the capital growth that you get from the share price. You need to put the two together. And what I have seen so far is company that pays out a very high regular dividend there's probably little action in the share price. So maybe you're getting a 5 to 6% yield from your stock, but that is the total shareholder return that you end up getting, which is not a lot.
Missing out on growing the shares. Okay, that's our myth well busted there. Thank you very much indeed, Stephen. Well, Stephen, we've got a couple of minutes left, and we're going to take another few questions from listeners. We've got two similar ones, actually. Tony and Tim, who've written in separately. Tony says that he's worried about bubbles and what's going on with the huge chip market, so companies like NVIDIA. It reminds him of the vendor financing back in 1999, when huge telecoms companies lent money to their clients to buy telecoms infrastructure. And Tim says that NVIDIA is reliant for half of its revenue from just a few customers. And you say you're cautious about those companies which spend huge amounts of money and prefer the suppliers rather than the buyers. But what if the buyers suddenly rein in their expenditure? That would be a huge hit to companies like NVIDIA. And on top of that, there are reports of NVIDIA investing in their own customers. So there's a circularity here, and it's looking to those two listeners a bit like a bubble.
Thank you for those questions. Very, very timely and topical. So on a very high level, we don't disagree with the view that we might be entering into a bubbly territory. But of course, then the question is, what is the definition of a bubble and where are we in this bubble? Our view is we are at the very early innings of the AI development cycle. And the one thing I would say friction in how quickly AI will be adopted or penetrated is availability of money. And what do you need the money for is to invest into GPU compute. Just to remind our audience that there are 3 million apps on the Apple iOS, which everyone can download to use. And there's a lot of readily available data that the AI can make sense of or to come up with use cases. So what NVIDIA is doing is basically supporting OpenAI, which is not a profitable company today, in contrast to the big tech companies, Alphabet, Meta, Amazon, and Microsoft. They are able to invest a lot heavily into AI than OpenAI. And if OpenAI hasn't got the money, it would just postpone that journey for a couple of years. And then the penetration in terms of ecosystem would be a lot slower than if they have the money to invest now. So to us, ultimately, the question to ask is whether you believe AI is going to change the world, change the way that we live and work. And if you do, then we are probably at the very early innings of that journey. So would I worry about that $100 billion being invested with OpenAI? I wouldn't too much from an NVIDIA perspective, just because NVIDIA is generating about $100 billion of free cash flow this year. At the same time, if you put $100 billion of this number in the context of NVIDIA's market cap, which is about $4.5 trillion, it's only a few percent of the market cap, which is not even worth probably spending too much time to consider.
You don't get out of bed for $100 billion. Okay, so the idea then is that you're taking a view around this, that we're still very, very early in the development of AI, and NVIDIA is investing in the future growth of one of its main clients, but with taking a firm view that future is pretty healthy.
That's right. And just going back to Tim's question about the concentration of customers, that we haven't seen enough from enterprises which are coming in to invest into AI. If you think about British Airways, Santander, HSBC, JP Morgan, many companies that are now just started the journey to invest. So over time, NVIDIA or Broadcom are going to be less dependent on the big tech customers. It's going to be the enterprises who are going to take up the slack to invent more AI applications.
Good. Well, Tony and Tim, I hope that answers your questions. Thanks very much indeed for sending them in. Well, that's it for this episode. Thank you, Stephen Yu of Blue Whale Capital. As you've heard, we love getting listener questions, and Stephen will try to answer them about Outperformance Matters. Write to producer@bluewhale.co.uk. Thanks for listening and watching. And if you've enjoyed this, do tune in again and leave us a review on your favorite podcast platform. Remember, Outperformance Matters. Goodbye.
Please note that this podcast is issued for educational purposes only by Blue Whale Capital LLP, which is authorised and regulated by the Financial Conduct Authority. Views expressed on companies, market, constitute investment recommendations and must not be viewed as such. Listeners should note that any views expressed may already have been acted upon, may no longer be current, and may not be revised or updated. Nothing in the podcast should be viewed as comment on the suitability of any investment. If you're unsure of the suitability of any investment for your needs, or if you feel that you do not fully understand the risks of investing, you should obtain financial advice from a reputable professional financial advisor before proceeding. You are reminded that your capital is at risk. The value of investments could go down as well as up, so you may get back less than you invest. Tax treatment depends on personal circumstances and may change. This podcast is directed only at UK residents and does not constitute an offer or a solicitation in any jurisdiction.